Good morning, everybody. This is Samantha, and this is episode 3 of Meet Me for Coffee with Samantha Jones. Really excited today to have my friend Ken joining us, and looking forward to bringing him in just a minute. I did want to go ahead and remind everyone that I am currently in the process of deciding on a coffee sponsor. So I would love for my audience to drop some awesome suggestions in the comments, whether you're listening to this live or if you're watching it on a recording. I need some more ideas of coffee companies that are out there that I can look for a sponsorship partnership with. So please drop your favorite coffee brand in the comments, and I'm excited to look through those after the show. So today we are going to be discussing something that I think is very timely. A lot of us are wondering, as we wrap up this year, where are we at? Where's the freight market currently at for truckload? Where did we come from? Where are we going? Those are all great questions, and those are all topics that we're going to get into. And so without any further ado, I'm going to go ahead and bring on my friend Ken to talk about those things. Good morning, Ken.
Hello, good morning. How are you?
I'm good. How are you?
I'm doing wonderful. Back to back this morning.
I know. I was like, you just got off the podcast to get on this.
I did.
And then you have another podcast after this.
I do. I have the Freight Coach later this morning, and then we're presenting with some of our partners at OTR Solutions to round out the morning. So that'll be fun.
So it's just a full day. It's a really
normal day in the life.
Just a day in the life. That's awesome. Well, for anyone on this podcast who might not know you, which I feel like we mostly do, but I'd love to know a little bit more about your background and kind of what brought you into the industry and why you've decided to stay despite the madness. So I'd love to get a quick background from you.
Yeah, so out of college, I got into deregulated energy, and most folks who stay there long enough end up in jail. So I decided to exit that industry after about 3.5 years. It's funny, they were the big corruption scandal in Ohio. They're pertaining to deregulated energy. But I went to FedEx thinking it was going to be a short stint. Thought freight would be boring, and over a decade later, I just absolutely love this industry. So I did pricing, decision science, process engineering, and strategy over at FedEx. I was a DAT customer the entire time. So using the data to build pricing models, predict call center volume, anything, right? Came over to DAT 3 years ago this week. So it's my 3-year anniversary. At DAT, I do product development for our analytics products, data science, professional services, industry analysis, and data operations. So that's my story.
Yeah, that's really cool. Talk to me maybe a little bit about how things have changed since you first came into the industry on the data analytics side.
I think the biggest change has been the amount of information that's available. We were joking yesterday, when I started, it was DAT was all that was available. And that's what we called it, was DAT, the DAT. And, you had access to that information, and pretty much that was it. You had some dated reports that came out maybe monthly, or if you could snag a sell-side analyst report from Wall Street and use that to back into where the market was headed. Morgan Stanley was always a really good source, but it was a bit dated. Now, there's tons of information. I mean, we're inundated with just absolute pantheon of information you can go research out there. And I think whereas the struggle early on was finding anything to help you make better decisions, the struggle now I see, especially with a lot of younger analysts, folks new to the market, is sifting signal from noise, right? Any jabroni with a Twitter handle can prognosticate about what's going to happen in the freight markets now. And if you're not careful, if you're not seasoned and experienced, or if you're not thoughtful enough to ask questions, you could fall into the trap of making poor decisions based on less than stellar data or analytics. So that to me has been the biggest change for the good and for the bad. And I think it's been overall net positive, 99% net positive. I think it's just something to be mindful of as we're seeing all of this data at our fingertips.
Okay. I'm naturally optimistic, so I like that. 99% net positive, so that's good. Let's go ahead and talk a little bit about, I think this is really, like I said, it's timely. There's a lot of people wondering right now, trying to understand how do we interpret all of this data that we're seeing, all of the economic headlines as well, and how do we kind of understand where are we at right now. And so can you help us just understand a little bit more as someone who's lived in the data every day this year? How did we start 2022? What's happened in 2022, and where do we sit right now as we're wrapping up the year?
Yeah, I think it's really important to understand the 3 sort of contextual time domains of data: past, present, and future. So you have a way to flip that is current, leading, and lagging indicators. So lagging indicators aren't altogether bad. They help us understand where we've been. And in the freight markets, if you look at that long-term sinusoidal curve, where we've been largely, at least from a market structure perspective, helps us understand where we're going. History doesn't repeat, it rhymes, that all those cliches. So looking at the historical data coming into this year, we would have predicted the market to regress back to normal. So that's what the historical data would have told us. The current data would have told us, wow, we just had the best peak season ever, like in the history of anything ever. People were spending as much as they possibly could. They couldn't keep shelves stocked. It was, absolutely crazy. That's what the current data was telling us. Forecast data was sort of reaffirming that. It was going to be the time of the cycle where we would see markets start to contract. Contract markets would largely plow through the year and then maybe start to tip over towards the end. And I think that painted a pretty good picture. Where we got it wrong, we as in the collective and myself personally, maybe didn't anticipate as much of a drop in the spot market. I think we were predicting 15 to 20%. It was obviously more than that. And then contract rates, that was pretty spot on, but I get the sense that we're going to be we were under forecasting what's going to be like Q1, Q2 of next year. I think we'll see continued weakness in the actual moved contract volume heading into next year.
Yeah, I think that you bring up a great point there as we're moving into 2023 and we're thinking about, where is this bottom of the current rate cycle? And we are all in agreement. There's not any dispute that we're on the, downward side of a rate cycle right now. But the big question and the thing that people can't seem to quite fully agree on, because there is some unknowns in this and any type of variables could potentially delay, but where is that bottom? And once we hit that bottom, at what point are we coming back up? So I think that that's kind of something people are trying to take their best educated guess and make some speculations on. Any thoughts for us there as far as when, you personally would expect to see this rate cycle hit its bottom and then start its climb back up? Did I lose Ken? Oh no, guys. We're going to give Ken a second to get back in here. Maybe we can make Samantha's prediction in the meantime and then see what he says to see if it's the same as me. Samantha is predicting a rate bottom in mid to late Q1 and then maybe some holding steady time and then a slow progression into the upward rate cycle for the rest of 2023. Let's see what Ken says when he gets back in here. All right, Ken, you're back. And I just, I rolled the dice there and I made my own prediction. And now we're going to see what you say and see if we're different. And
that was actually planned. I was going to go away so I wasn't biased by your prediction.
Yeah. So
you're talking about for 23?
Yes, we'll see how right you are now about when we're going to find rate bottom and when it's going to start going up. Because, if I was giving people advice, I'd tell them to take your prediction over mine. So we'll see.
I think we're probably there for spot rates. I we'll see some contraction. I think we'll give back what we gained, right? So we're in quite a peak rally right now. It happened later than we thought, which was making me sweat a little bit. I think a lot of other people, but rates have fallen in line. They're sitting exactly, actually they're outperforming 17 and 18 from a same day of the year perspective. So I think we'll probably give back after return season what we gained, but I don't know that we'll bottom out much lower than we did in that pre-Thanksgiving trough from a spot rate perspective, excluding fuel, especially if we continue to see this break, if you will, that carriers are getting on the fuel side. So to that point, if you're saying we're kind of at the bottom already. So then the question is going to be, when do we start moving back upwards? And Fernando just asked a question that I think is perfect timing. And it says, what's going to be the catalyst? So what is it that drives that point where now spot rates start to increase and we're moving into the upward part of that rate cycle? Yeah. So I'm going to use a freight cliche. It's going to be produce season. Anyone who's been around freight people long enough know that we talk in like a boggle game of just cliches, whether it's peak or whether it's the cycle or produce season. So it's going to be, I think, produce season or what will be the catalyst to drive spot rates up. I do want to caution folks, though, and it's hard to think about, so you have to level set. Contract rates will likely carry forward some negativity through probably towards the end of the year because the contracts being signed now, And I know paper rates is another freight boggle term, but those will carry forward into the year. So freight will move under the current contracts that are being signed for at least 6 to 9 months into next year. So while I expect produce season to start seeing the trend move upwards for spot rates, I don't expect us to flip year over year for contract until potentially into Q4, if at all, next year. So there's a little bit more mystery clouding contract rates. But if I'm operating predominantly in the spot market, I'm going to expect it to be pretty slow late January through February. March, once produce season starts ramping up in the South, I would expect rates to start pushing upwards, culminating in a 4th of July that should be pretty good.
So Richard just asked, when will contract rates hit bottom? And I would say, kind of based on what you just said, we're going into a big RFP cycle right now. I mean, we're in a lot right now. At my company, we have more coming out in January and the first of the year. So those are oftentimes going to be 12-month RFP cycles. And so like you just said, with contract rates maybe not having that upward pressure until the end of 23, would you say that contract rate bottom is essentially now for a while, and what's about to be negotiated and put into place in the next, say, 3 months?
No, I think contract rates will continue to plot downward. Probably, you'll see if you're tracking moved freight under contract, you're going to see a pretty continual linear downtrend for at least, I don't know, at least 1.5 to 2 quarters, I would guess, before you start to even see some slowing. So what needs to happen? What needs to happen for the market as a whole to flip is the difference between spot and contract to converge. And I prefer to look at that on a year-over-year percentage basis as opposed to an absolute basis, but really they're relatively indifferent. So there's 2 ways those things can converge. Either spot can bottom or start going down slower and contract can continue accelerating downward, or spot can come up. What'll happen is if spot starts to come up and contract keeps coming down, they'll close the gap twice as fast, right? If spot's going up, like for produce season, and contract keeps coming down, you'll see those lines intersect at a pace twice as fast. So that's, if you're a more optimistic thinker, if you don't think we're going to enter a recession or it's going to be a very mild recession, then I think what you'll be looking for in the data as we get into the first half of next year is spot rates improving and maybe the decline in contract rates slowing down. And then once those 2 things meet, your RFP philosophy should largely have already flipped, right? When you're pricing freight forward. So that's how I think about it. But there's probably at least another 10-ish% left to give on the contract side. And we track replacement rates. So unlike a lot of folks in the industry, we track new contracts coming in the routing guide, and they're still coming in about 10 to 12% lower, which means freight volumes moving under those contracts are going to move 10 to 12% lower over the next 6, 9, 12 months. So,
okay, so that's a perfect transition. Let's kind of transition right now into a conversation more centered around RFPs, because 'tis the season, right? This is a popular time of year for RFPs to be run. And I know you probably get this question a lot from, broker and carrier partners. You probably hear it even from shippers. And that's, from the broker carrier standpoint, when we're entering RFPs that are 12-month pricing agreements, and we know that this is a year where the market cycle is going to change at some point mid-year, what are people thinking, and what can they be doing to prepare for that? Because this is a little bit different of a pricing strategy now, because that pricing is going to change on you mid-cycle. But yet, let's say you're a broker who, like my brokerage, we want to provide rates that are going to be realistic, that we're not going to have to come back and renegotiate with you constantly or mid-cycle. So what are those conversations look like when DAT has those with their users?
So this is the scariest time to price. You're 100% correct. When I was pricing non-asset, when there's going to be a market flip or you're fairly confident, timing that flip is very important. And here's why. And the most common question we've gotten, this is like on the order of 6 to 10 a week for the last 1.5 to 2 months. I know my competition, or at least some people that I'm competing with in this RFP, are going to price to the current market. And they're just going to dump the shipper or reprice them when the market flips. So I can either do what they're doing and price ignoring what I know is going to happen, right? Or I can price to what I know is going to happen and not win the freight. So I think the best middle ground there is to say, look, I can give you a 6-month contract at the rates that these other brokers are pricing, but I know that this market's going to flip. This market's going to flip next year. So why be left in the lurch with a broker or a carrier that's going to want to upcharge you midway through the cycle. So in that way, if you offer a shorter term, then you're essentially making whole on what you commit to, and not looking the other way with what you presume to be true based on the data and your pricing analysis. So that's an approach.
People talk about relationships a lot in our industry, and I feel like it almost unfortunately gets overplayed that everybody says relationships are important, but do they mean it, type of thing. But this is a year where, we know this within our brokerage, and we are leaning heavily on our relationships where you can have good conversations around that, right? You have to know the people you're working with on the shipper side and on your broker and carrier partners to be able to have a conversation around, here's the strategy behind our pricing, here's why we're doing what we're doing. Here are some options. And so I would just encourage people right now to be thinking about that. If you haven't already, I think there's been a lot of excitement around rates going down on the shipper side, that maybe it's going to be tempting to want to really maximize cost savings this year on those rates. That might be what we would call a paper rate, or even a 6-month rate. So at least
I like the way you worded that. You didn't take the dramatic route and say the shippers are getting revenge. They're out to stick it to their carriers because of the bloodbath, right? They're out to get that revenge. No, that's not what's happening. It's a market functioning.
Yes.
Really.
So conversations will be important this year. This is going to be a little bit different, a little bit challenging on the pricing side for our brokers and our carrier guys. Very thankful that we have a stellar team on our side, and it's not just me that has to figure all of that out.
It took me a while to understand this, and I'm 3 years being on the other side of the fence now, is that the average tenure of a broker pricing freight on the floor is under a year. So this isn't the career for most people, right? Most people come out of college, they come off a stipend and they flame out, or they spend, they have some initial success, but they don't really last. So the ones that are successful in brokerage are there because they've been successful. So it took me a while to realize that why are these brokers continuing to make the same mistakes? And it's because it's not the same people making the same mistakes. It's newbies who have, there's a lot of people right now who have never seen a down market, right? They were born into the industry.
That's so true. That is so true. So I actually came into the industry, Ken. I've only been in the industry since 2019. So, it was...
You've seen the tail end of a slow
time prior to getting into pandemic years, right? So this is kind of new territory for me, and for a lot of people, even because the last few years have been so abnormal as well. So that's another thing is, think if the average tenure was at 1 year, well, for the last 3 years, we've had some pretty just abnormal years. The market was exaggerated. The cycle was exaggerated on both the highs and the lows is what we're seeing. So it's really a new time for people entering this market. I think, just curious, what would be your suggestion to people that are coming in right now trying to navigate this from maybe a data analytics side, like what you do, in the pricing side? You've done pricing before in your career. So what would be your thoughts and advice for anyone who might listen to this that's actually the one pricing freight?
I think relationships are key, not just with your shipper, right? There's going to be people within your own shop that have been through these cycles. So I've seen a record number of brokerages and even shippers do internal lunch and learns, or bring someone like us, or someone out there in the industry that's doing this kind of stuff, or even internally, if they have enough folks, if you're a large enough shop, to just talk through it. Even if once a quarter you're sitting down with your newer folks and even your seasoned folks, and just talking about where the market's at and understanding things over a longer arc of time. So, when we sit down and have that conversation, we're going back to 2010 and looking at year-over-year changes, because that way you're capturing 3 or 4 of these cycles.
I enjoy our conversations, Ken. I know I talk to you every once in a while on the market, and that's always when you're like, well, remember back in? I'm like, no, we don't. So I'm glad we're having this conversation.
Yeah. So those are the things, right? People have been around. The data has been around for long enough, and freight data existed before 2019. So if you go back and look, there's a lot of times I was super fortunate, right? I'm in a part of the country where Roadway was, back in the day, one of the largest transportation companies in North America at one point. So we're peppered with these. I've had so many great mentors who helped me understand what 2008 was like, right? When I was starting in 2000, whatever it was, 2010. Yeah, some way ago. I had people who helped me understand what those markets were like, so that when the 2016 industrial slowdown happened, we could proxy a different point in time. So I think that's part of it. Talk to your customer in a lot of ways. Like shippers, it's been so positive to see some of this adversarial. We had our DatCon event this year, which is our annual user conference. Mm-hmm. So for the first time, we had shippers and brokers in the same building for 3 days. And some folks on our team were worried, like, are they going to kill each other? How the state of Texas is not big enough to bring shippers and brokers and carriers together under one roof. And at the end of the day, it was like, oh yeah, I have this problem. And then someone overheard, and they're like, oh, but wait, I'm dealing with the same thing. Like, I'm sending all of my trailers into this location, and I have no backhaul out. Like, what am I going to do? I'm not big enough to reposition trailers on an intermodal heading back west. So I love that some of that and some of it's been out of desperation, if we're being honest, right? They've had to change their ways. Yes. But it's going to stick. I'm optimistic that sticks, because everyone benefits when we're more collaborative.
I love all this optimism this morning. I didn't read the directions on my new pre-workout this morning, so I'm pumped and ready to go for this conversation. We did have a question, and then we'll get to one more that I had. But Drew asked, given how contract rates are down right now, should we expect contract rates to rise this time next year for RFP season?
Yeah. So if what we talked about was spot manifests into reality, so if we see a rebounding, I won't say resurgent, I'll say a rebounding spot market next year, yes. So think about contract rates when they're formed are largely a function of the spot market at that time. That's why the leading lagging relationship exists. So the contracts that were written, the prices that were negotiated when spot rates were really, really high, ended up being elevated. Mm-hmm. And then spot rates fell, but those rates were all they lag, right? They've been you sign the contract, it goes through red lines, you execute on it, you put them into the shipper's TMS, you put them into your TMS if you're big enough, and then you move a bunch of that freight under that contracted rate. So that's why under this weak spot rate environment, you're seeing lower contract prices. Now, the reason contract never goes as low as spot rates dip or as high as spot rates peak is that those spot rates have already peaked and started to come down, or bottomed and started to come up before contract rates can let out all of their kind of momentum. So that's what I would expect to see. But by the 4th of July, my expectation is if spot rates have rebounded, you're going to start to see less and less downward pricing pressure on contract. But it's going to take a while for the contracts you've already signed, the contracts that everyone's already signed, to move their way out of the system, right? So that's why I think you'll see that negative momentum carry into the fall, even though I would expect, if I was a gambler, which I won't talk about that, but let's just say hypothetically I was a gambler.
Ohio State.
Go Bucks. I would expect contract replacement rates to at least normalize, if not go positive, by Q3 of next year. But that still means that the moved freight will be negative for the foreseeable future at that point.
Awesome. Thank you.
Long-winded answer. I apologize.
No, that was perfect. We got a couple questions coming in, so we'll just shift to some questions.
Yeah, let's do it.
Ryan asked you, what volume mix does DAT see right now for spot versus contract? So when you guys are doing the analytics, what is it that you're seeing?
So I can't prognosticate on the entire market. I will tell you that because we're not big enough. We don't see all of the contract freight. So I'm not going to speak on things. I won't get into that. But typically it's 85-15, right? If you went and took a 20-year strip of spot versus contract, it's about 85-15. During COVID, we saw it peak at about 78-22. In some markets, in some equipment types, up to 70-30, which is remarkable. I mean, that's wild to think about. It's trickling back. Last I saw, it was roughly around 18-ish% spot. My guess is by the time things normalize, we'll go back to that ratio. But anywhere between 15 and 20% spot is what I would consider a normal functioning market. Here's where it gets interesting. We couldn't figure out why we were continuing to see a lot of spot freight on our board, even though total spot freight moved went down.
Okay.
The answer? Brokers won a lot more RFPs during COVID. Right. Where do brokers move contracted shipper freight? In the spot market. So
Ken, I am so loving this conversation because I just argued this with someone yesterday, and I took your position on that there are absolutely brokers out there who will price contract freight to cover in spot markets. And
95%.
That's how they're able
90,
to
yeah.
create higher margins and take advantage of those low spot rates. It's not necessarily always savings that gets passed on to the shipper, right? Because it's a contract rate, but it's operating at a spot rate for the broker. And that's where brokers are able to inflate those profit margins. So
or they get pinched when the market goes. I want to make sure that we're being fair to both sides, right? They do get higher margins when the markets fall, but when markets rise, they get pinched.
Right. No, that's true.
Right? Yeah. Absolutely. And that's the interesting thing. We saw a 200 basis point increase in shipper to broker contract, which is fascinating. That's a huge amount of freight, right? I mean, on let's just say it's $400 billion. That's a massive amount of freight that shifted into being spot on the coverage side. Mm-hmm. So it was contract buy, but it was 90% spot sell. So that's when I think like the intricacies of this market and the fact that contract is such a bigger piece, you have to keep that in mind. Like a 1% shift from spot to contract can be a 10% increase in spot volume, right? Or from contract to spot.
And this year in 2022, as the spot market fell so quickly and so much so under contract rates, what I saw a lot more in our shipper partners is after primary tender rejection, of which there were not a lot. So we do have to say there weren't a lot of primary tender rejections. But after that point, forget the routing guide. If I move this to spot market, I'm going to save 20% from secondary position. So we also had a lot of shippers using spot strategically, which as they should, right? To save some money where you can still get your loads moved and covered on time. So I think that spot also had a unique position in the market this last year, 3/4 of a year, I guess, in 2022. So that was something that I noticed different in shipper behavior too.
Yeah, brokers have this perilous three-legged stool they have to manage, right? And, I always get my chops busted by shippers when I go into the sob story for brokers, but I'm going to do it anyway. They're playing with margin, volume, and rate. Mm-hmm. So what ultimately pays their rent and what ultimately keeps the lights on for all their fixed costs is revenue, total revenue minus total cost, which is very sensitive to the number of shipments you're moving. So, we love to kind of skewer brokers for this margin expansion. We should just create like a tapestry of freight terms, cliche freight terms. So margin expansion. Like, how could that broker possibly sleep at night making an extra 5% on this load, 5 nominal percentage points? But the fact of the matter is they're probably moving 5% less shipments, right? So what they're trying to balance is this sense of I'm moving less freight, so I need to make more on the freight. Or what about length of haul, right? So one of my good buddies in the industry, Andy Smith over at Circle, made a really good point about if you're looking at just shipment indices and not considering length of haul or tonnage, you're not really getting the whole picture on how much freight's actually moving out there. Because if my shipments increased by 5%, but my length of haul went down 10%, and I get paid on a per mile basis, which we all do, I'm out 5%, right? So it's way beyond cursory level, the mechanics of how the industry, I think, normalizes, right? And in the order with which rates normalize, and then volumes normalize, and then tonnage and load factors normalize. And then ultimately you see like these long-term shifts in length of haul as distribution strategies have changed. So that's why this industry is so awesome, in my opinion.
There's never a dull moment, right? It's
never.
Constantly something different, and you're never just looking at the same exact situation month over month. That's what's cool about this. One last quick question. I've never asked you this, so I don't know. What are your thoughts on the LTL market for 2023? Ken, do you get involved in the LTL space at all?
Yeah, I think so. From an LTL operator standpoint, I'll field the question first. I'm assuming they're hoping and they're very happy that they're going to get some of their line haul networks and intermodal back into normal, right? What a lot of people don't realize is, especially a lot of economy LTL on the back end is moving from the spokes back to the hubs and all around the country through intermodal and purchase transportation. So the largest LTL networks in the country, a lot of them have very high ratios of intermodal and purchase transportation, specifically moving their economy stuff around the country.
Right.
If I'm a purchaser of LTL, if I'm a shipper or if I'm a broker that needs to go purchase LTL, I think the dimensional weighting thing is going to be something to keep in mind. LTL pricing is hard enough to understand as we move away from freight class and in terms that most people don't even relate to, like Czar Light and all of that stuff, and get into more dimensional weighting. I think that and keeping an eye on intermediate general rate increases throughout the year to catch up with inflation will be two things that I would keep in mind, because the GRIs are coming out this year, probably in the 6 to 8% range. Is that what you've seen?
Mm-hmm.
It'll be interesting to see if we.
A lot of people did experience record increases, whether they called it a GRI or whether it was just an out of cycle increase in the last few years. I mean, there was a lot of double-digit increases negotiated outside of GRIs. And so I think a lot of people kind of had this hope and this expectation that maybe that would cease the GRI, or the GRI would drop to a very low nominal percentage. But I don't think we're going to see that be the case.
LTL pricing's whack, right? I mean, when I started in the industry and I got handed an LTL pricing sheet, it's like, okay, look, we're not giving them a big discount. And I'm like, okay, what are we giving them? Like 10 to 15%? They're like, no. We'll start them at 80% off tariff. I'm like, what the hell?
Ken, here's a question I have. I've long said this. When do we hit reset? I mean, there are literally tariffs out there in the LTL space with 97% discounts. At what point do we just say, let's call it and let's go back to zero and start?
LTL is the most. I love LTL. I sounded like Donald Trump. I love LTL. LTLs are my biggest fans. No, but I don't know. It's the most kind of obscure. Like you have, I think if anytime someone starts a sentence with, I've been doing blank since blank, you pretty much have to disregard everything they say after that. But I find that you find more of those people in LTL. And I'm not disparaging LTL. I love LTL. But I think you have a lot of stalwarts in that industry that don't really have a vested interest in changing. Like state-to-state matrices, huge discounts. I'm sure dimensional weighting makes them want to barf. So it'll be interesting to see how that, because right now where's the break? The most important metric we studied with LTL when I was in the industry is the break point between volume and going truckload. And that could go anywhere from 8 to 12. And then in some cases, 14,000 pounds. I wouldn't, with how spot rates have fallen, that's probably over 12,000 pounds right now, where you could ship a partial less than you can ship LTL right now. So
correct. Yeah. And double that, with a lot of carriers stopped wanting to take the volume loads. And so they made their prices inflated on anything 6 pallets or higher. So, and the one other thing I would say about LTL going into this season is that you have carriers now who have fully implemented, developed, and perfected their dynamic pricing programs. And those are literally designed to create freight moving and tonnages up during these slower cycles and offer some, while not on tariff, but still offer discounts for the shippers when it makes sense.
Yeah.
So hopefully that's going to help a lot of people get through what's always a slow season in LTL as we move into Q1. So
for sure.
This has been a ton of fun, and I always enjoy our conversations. I'm going to let you get out of here so you can make it to your next podcast on time. But it was a pleasure having you today, and I would encourage everyone, if you're not already following Ken on LinkedIn, please go over and do that. He's a wealth of information, as you all heard, and I'm sure he'd love to get connected with you there as well. So
thanks for having me. It's been great.
Yeah. All right. Looking forward to it, and enjoy your next podcast and the rest of your day, Ken.
All right. Thank you again.
Yep. Anybody else who is not going to be working on December 27th, we are still going to have the Meet Me for Coffee podcast episode 4. I think we're going to go ahead and do a nice like hottie toddy recipe because everybody's getting cozy in their living rooms. So you can join my friend Graham Gonzalez and I. We're going to keep the conversation pretty interesting, pretty lively, and we're going to be discussing broker, carrier, and shipper contract terms when it comes to insurance. Are these high value amounts that we're starting to see appear more frequently in contracts really necessary? And what type of challenges does that pose for the brokers and the shippers who are choosing whether or not that's a paper that they want to put a signature on as they go into those partnerships? So we're going to have a fun conversation. We're also going to post the recipe for those hottie toddies that whatever Graham comes up with is what y'all can join us in drinking, and that'll be a lot of fun. So until then, thank you everybody. And we look forward to seeing you in 2 weeks for the next episode. Thanks, guys.